All right, we left off on slide 26 in the presentation. So we're shifting gears and going into bonds. And on slide 26, this slide provides the typical terms of bond issuance and the factors involved, such as face value, maturity date, and contractual interest rate. Note that interest on the bonds is paid all through the life of the bonds on a regular schedule. The slide says semi-annually, but some pay quarterly as well. On slide 27, here's an example of a bona fide bond with principal or face value, interest rate, due or maturity date, and the issuer all identified. And on slide 28, in determining the market value of the bonds issued, we are determining whether the bonds will be sold at a premium or a discount based on market conditions, that is, interest rates, amounts to be received, and so forth. The concept of present value says that a dollar received today is worth more than a dollar received a year or more from now. Excuse me. On slide 29, in this case, the market price of the bonds as computed above just so happens to equal the $100,000 face value of the bonds issued. Of course, this may not always be the case in the real world. On slide 30, this slide discussed a couple of important aspects of bonds. Bond transactions, besides regular interest payments, are not that frequent, only upon issuance, retirement, or when bondholders convert convertible bonds into stock, which we won't really be getting into in this class. As indicated earlier, bonds may be sold at a discount below face value or at a premium above face value, depending on market conditions, as well as at face value. And on slide 31, we have a question. The rate of interest investors demand for loaning funds to a corporation is normally the market interest rate. And if they don't get that, if they get something lower, that's where you're going to be selling bonds at a discount. If you're offering an interest rate that's higher than the market rate, you'll actually be able to sell the bonds at a premium. On slide 32, note that the entry to record interest expense and interest payable is the 10% charged over the full year, or $10,000, based on the terms of this bond issue. Note also obviously the initial entry where we have a cash infusion of $100,000 and a credit to the bonds payable long-term liability account of $100,000. It is a 5-year bond, so that's why it's long-term. Slide 33. This is the entry showing the actual payment of the interest accrued on the bonds at December 31st. January 1st, we debit interest payable, we credit cash to show that the interest was actually paid. Now on slide 34, here's where we get into the impact of the market interest rate on the bond price. For instance, if the market rate is lower than the contract interest rate, that is the rate the bond issuer is required to pay, then the bonds can be sold at a premium to recognize that the bondholder will earn a higher rate of interest on the bonds he or she holds than on other typical market investments. So they're paying a premium in order to get the better interest rate. The opposite scenario is when the market rate is higher than the contract interest rate. In this case, the bonds will be sold at a discount from their face value because the investor is accepting a lower rate of return than the current market rate. Why would they want to do that? Well, maybe for reasons of financial security. They believe that the bonds are a more secure, safe investment than maybe some other things that might yield a higher return but might also be more risky. And on slide 35, we have another question. This company is issuing 10-year bonds with a maturity value of $200,000. If they're issued at a premium, this indicates, well, what? And A is the right answer, that the contractual interest rate exceeds the market interest rate. So therefore, they're getting a better deal investment-wise, and so they're willing to pay a premium or over the face value of the bonds. Going to slide 36. Note the use of the discount on bonds payable account to record a debit for the discount amount as a result of selling the bonds at less than their face value. Therefore, only $98,000 in cash was collected on the sale of $100,000 worth of bonds, as the credit to the bonds payable account illustrates. On the slide, you can also see that the discount amount of $2,000 is added to the sum of the annual interest payments of $50,000 to determine the total cost of borrowing of $52,000. And on slide 37, here is how the bonds payable and the associated discount will be presented in the balance sheet. Note that the $98,000 is not labeled, as it is understood to be the net amount of the bonds issued. And on slide 38, another question. Discount on bonds payable is one of those contra accounts, so B is the right answer. And we've had some experience with other contra accounts, such as accumulated depreciation, sales discounts, allowance for doubtful accounts, and so on. So this means that the discount on bonds payable account has a normal debit balance, whereas the related bonds payable account, liability account, has a normal credit balance. That is why the discount on bonds payable is subtracted from bonds payable on the balance sheet. On slide 39, this example shows an illustration of bonds issued at a premium, presumably because the contract interest rate exceeds the market interest rate. Note that in this case, the cash collected or debited exceeds the face value of the bonds, and the premium on bonds payable account is credited with the difference. The box on the slide shows that in this case, the total cost of borrowing is only $48,000, $50,000 of interest minus the $2,000 premium on the bonds payable. On slide 40, here is the balance sheet presentation, very similar to the discount on bonds payable illustration, except that here we have a premium that is added to, not subtracted from, the bonds payable face value amount. On slide 41, when bonds are redeemed, that is paid off at maturity, the entry is performed as shown above. Bonds payable account is debited to write off the balance, and cash is credited, reflecting the payoff. On slide 42, this slide discusses how to handle a bond retirement that occurs before the maturity date. In such cases, there will be some amount of bond discount or premium, whichever one applies in the circumstances, that is not yet amortized and needs to be subtracted in the case of a discount or added in the case of a premium to the face value to determine the carrying value of the bonds at the time of payoff. So there may be a gain or loss on redemption to recognize at this time. So a question: when bonds are redeemed before maturity, the gain or loss on redemption is the difference between the cash paid and A being the right answer, the carrying value of the bonds, as was just previously stated. So this will be important for quiz and exam purposes to remember that the two key components here are the cash paid and the carrying value of the bonds in determining whether there's a gain or loss on the redemption. And if cash paid is greater than carrying value, then a loss occurs on the redemption because the company is paying out more than the carrying value of the bond. Just the opposite for the gain situation. If the carrying value is greater than the cash paid out, then a gain needs to be recognized. On slide 44, here is an example of bond redemption before maturity date involving our previous case with Candlestick. Notice that at the end of the fourth year, 1/5 or $400 of the original $2,000 premium remains. The rest has been amortized over the 4 years to date. This means that the carrying value of the bonds at the time of redemption is $100,400. Since the bonds are retired at 103, this means the payoff is 103% of face value, or $103,000, as shown by the credit to cash for this amount. Therefore, the difference between the carrying value, $100,400, $400 and the cash paid $103,000 is a $2,600 loss on redemption, since the cash payoff was greater than the carrying value of the bonds redeemed. On slide 45, here's an overall presentation of current and long-term liabilities in the balance sheet. Note the order of presentation under both the current and the long-term liabilities. That is, notes payable first, then accounts payable, current maturities and long-term debt, and then accrued liabilities, which include things like payroll and sales taxes. Be careful when summing the current and the long-term liabilities that you have the correct amounts, so that when you add them together, you'll get the correct total liabilities amount, which added with the owner's equity should then equal the total assets amount. On slide 46, here's a more short-form balance sheet presentation for Toyota that summarizes current and non-current liabilities in one line each. And this is one acceptable method of presentation, especially for a larger company. Remember the current ratio from a previous chapter, that is current assets divided by current liabilities. To be healthy, it should be greater than 1 to 1. In Toyota's case, it was healthier in 2006 than in 2007, when it was barely 1 to 1. And then we moved to a discussion of solvency type of measures. And here we see a couple of these measures involving the liabilities accounts we've discussed in this chapter. The first, debt to total assets ratio, is computed by simply dividing total liabilities by total assets as shown above. The second one, the times interest earned ratio, is computed by adding net income, interest expense, and tax expense for the year, and dividing that sum by interest expense to get a ratio expressing how many times the required interest payment is covered by current finances. Obviously, the higher this ratio, the better. And the reason that taxes are added into the numerator is to show what kind of shape we're in to cover interest before we have to pay the taxes. Many loan covenants require this times interest earned ratio to be at or above a defined minimum level. You can see it with the example above that Toyota was in really good shape in this area and well above industry average, while its debt to total assets ratio stayed about the same and was very close to the industry average. On slide 49, as explained in this vignette, some companies engage in debt masking to hide the amount of true debt on their books, which they are afraid might scare potential investors away in the current financial and economic climate. By making the debt to total assets ratio more attractive, that is, by lowering it, the hope of these companies is that investors will be more likely to invest in them than they would otherwise. See more details on this on page 564 of the text. And with that, we'll conclude this part of the presentation.